Welcome to Tech Money Madness, your daily U.S. stock market podcast,
Yeah.
May 2026. How did a geopolitical clash over oil tankers in the Middle East just make your next Nintendo console more expensive?
Yeah, I mean, it sounds totally crazy, right?
Yeah.
But it is all connected.
It really is. Today we're doing a deep dive into the daily market briefing. And, just look at your portfolio today. The S&P 500 and the Nasdaq just crossed into absolute record high territory.
Right. They're just riding this massive wave of AI and earnings optimism.
Exactly. And even the Dow finished the week in the green with marginal gains. So it paints a picture of this flawless, booming economy. But reading through today's briefing, that picture feels entirely disconnected from reality on the ground.
Oh, completely.
Because we just got the April jobs report, and it is a massive collision of mixed signals.
Yeah, the broader indices hitting those record highs, it kind of masks the actual mechanics operating underneath. So the headline figure that, Wall Street algorithmic trading reacts to is the non-farm payrolls number. And that metric tracks the total number of workers in the U.S., but it deliberately excludes farm workers because agricultural employment is highly seasonal. It distorts the overall trend.
Makes sense. And those April numbers jumped significantly higher than anyone projected.
Yeah, they did. So on paper, it looks like a massive win. I mean, more people employed theoretically means more money flowing into the economic engine.
Okay, let's unpack this, though. Because when you dig past that shiny headline, the briefing highlights some really terrifying red flags.
Yeah, there are a few.
It feels like a mirage of economic health. Like we are seeing a massive shift in the data from full-time employment to part-time work.
Right, which fundamentally changes how we should interpret that job growth. The headline metric treats a pieced-together 10-hour-a-week gig exactly the same as a stable 40-hour career.
Wow, so people aren't necessarily finding great opportunities.
No, not at all. Many are simply being forced to take on like 2 or 3 part-time jobs just to cover their rent because wage growth is completely stagnating. But inflation just continues to grind relentlessly upward.
And that dynamic right there is exactly what has the Federal Reserve completely
Yeah,
trapped.
they are backed into a corner.
The briefing points out they're widely expected to just sit on their hands, keep interest rates steady rather than cutting them. Can you walk through the mechanism of that trap? Like, why does a strong jobs report actually prevent the Fed from lowering rates to help people out?
Well, if we connect this to the bigger picture, the Federal Reserve operates on a dual mandate from the government: keep unemployment low and keep prices stable.
Right.
Historically, those two objectives sit on opposite ends of a seesaw. If you want to cool down inflation and stabilize prices, you raise interest rates.
Because that makes borrowing money expensive, right?
Exactly, which slows down business growth and usually pushes unemployment up. But right now, we have this bizarre gridlocked scenario. The job numbers look incredibly robust, maybe even running a little too hot. But the cost of living has become completely unmanageable for the middle class.
So they're paralyzed. If they cut rates to give you some breathing room on your credit cards and mortgages, they eject more cheap money into the system.
Which sends inflation right back into the stratosphere.
It feels like trying to drive a car with one foot slammed on the gas, the job growth, while the other foot is just pumping the brake, fighting this unbearable cost of living. Are these red flags in the jobs report actually what the Fed is secretly hoping for to cool the economy down?
Pretty much, yeah. Keeping interest rates locked at these elevated levels is really their only play. It signals that the Fed's primary nightmare is no longer a recession. It is entrenched systemic inflation.
Right.
They are looking at the underlying weakness in those part-time job numbers and deciding that the risk of higher prices is vastly more dangerous than the risk of a cooling labor market.
And that domestic pressure is being severely tightened by fires burning overseas.
Absolutely.
When everyday consumers are stretched this thin by inflation, any shock to the global supply chain is catastrophic. And today's briefing is loaded with geopolitical shocks that are directly hitting company bottom lines.
Yeah, and we should be clear here, regardless of where you sit on the political spectrum, the market only cares about the mathematical realities of policy and conflict. We're just looking at the facts from the briefing.
Right, exactly. We're just following the math.
And the math right now is pointing toward a massive, expensive supply chain bottleneck. President Donald Trump has issued a hardline threat to the European Union, promising much higher tariffs if a trade deal isn't signed by an upcoming deadline.
And simultaneously, the fragile ceasefire between the U.S. and Iran just ruptured.
Yeah, that escalated quickly.
The U.S. announced it struck two Iran-flagged oil tankers that were allegedly attempting to skirt an international blockade. So I'm trying to connect the dots here between those oil tankers in the Middle East, the EU tariff threats, and the earnings reports coming out of the automotive sector today. Take Toyota, for example.
Yeah, Toyota is a perfect case study for this.
They just reported their fourth quarter earnings, and they missed their profit targets by a mile. The glaring metric from the briefing is a staggering 49% slump in their U.S. sales.
Which is, I mean, a 49% drop for a global staple like Toyota is absolute devastation.
Yeah, how does that even happen?
Well, this raises an important question about how global auto manufacturing works. A company like Toyota relies on an incredibly complex, interconnected supply chain. Raw materials and finished parts are shipped across oceans long before they ever reach an assembly line.
Right.
So when an oil tanker gets struck in the Middle East, global freight insurance premiums spike instantly. The cost of diesel fuel for cargo ships skyrockets.
Oh, wow. So everything gets more expensive to move.
Exactly. Shipping companies are forced to reroute vessels to avoid conflict zones, which adds weeks to transit times. So the baseline cost of simply moving parts from point A to point B gets vastly more expensive.
And then you add the threat of heavy tariffs on top of that already inflated shipping cost.
Right. Because a tariff is essentially a penalty tax on goods crossing a border. The foreign manufacturer doesn't just absorb a 20 or 30% tax out of their profit margins.
No, they pass it on.
They bake that cost directly into the sticker price of the car sitting on the lot. So an American consumer who is already struggling with the inflation and stagnating wages we just talked about walks onto a Toyota lot, sees a massive price hike on a standard sedan, and simply walks away.
Yeah, they just can't afford it.
The geopolitical tension combined with tariff threats directly engineers that 49% sales slump. It acts as a direct, unavoidable tax on the consumer.
Okay, but if I'm looking at this Toyota data and looking at the paralyzed Federal Reserve and looking at strikes on oil tankers, how on earth are the S&P 500 and the Nasdaq breaking all-time record highs today?
It seems impossible, right?
It genuinely makes no mathematical sense to the naked eye. You have half the global economy suffocating under shipping costs and inflation.
It only makes sense when you factor in what we call the tech exemption.
Okay, what is that?
The stock market is completely bifurcated right now. Traditional manufacturing, retail, and global supply chains are suffering exactly as the data suggests. But the tech sector, specifically anything touching artificial intelligence or semiconductor manufacturing, is operating in an entirely separate, gravity-defying ecosystem.
And the numbers in the briefing back that up with staggering force.
Yeah, they do.
The tech sector is heavily outperforming the broader market, driven by NVIDIA, Microsoft, Apple, and AMD. Let's look at the specifics here. AMD surged over 18% today after posting exceptionally strong earnings.
Huge jump.
We did see some mixed post-earnings performances from companies like ARM and Palantir. But then you look at Intel. Intel shares absolutely soared today following a report about a massive new Apple chip deal. The briefing suggests this is signaling a total pivot for the entire chip-making industry.
Right, and the focal point of that industry pivot is memory.
Memory chips.
Yes. To understand why the tech sector is seemingly immune to the macroeconomic drag right now, you have to understand what artificial intelligence actually requires to function in the real world.
Okay.
We tend to think of AI as an abstract software concept, like a helpful chatbot on a screen.
Right, just code floating in the cloud.
But large language models require colossal physical infrastructure. They need to hold billions of parameters in active memory simultaneously just to generate a single response. That requires highly specialized memory chips, and the demand from trillion-dollar tech companies is just insatiable.
Which perfectly explains Micron.
Exactly.
They are a major producer of these memory chips, and the briefing notes their stock went completely parabolic, surging nearly 38% in just 1 week.
It's wild.
38% for a massive company in 5 days is almost unheard of.
Yeah, think of the AI boom like a city where tech giants, Microsoft, Apple, NVIDIA, are racing to build 100-story skyscrapers as fast as humanly possible. They are buying up every single block of concrete on the global market at massive premium prices.
Wow.
Micron is the company mixing and selling that concrete. They are operating in a state of hyper-demand.
Here's where it gets really interesting, though. If the tech giants are buying up all the concrete, what happens to the smaller companies? Like a company like Nintendo is just trying to pour a simple driveway, but there is no concrete left for them to buy.
That is the exact bizarre casualty outlined in today's briefing. Nintendo officially announced a price hike for their upcoming Switch 2 console, and they are explicitly forecasting a decline in sales
Just because of the chips.
because they are caught in what the industry is calling a memory crunch. They need those exact same memory chips to build a video game console. But Nintendo simply cannot outbid a trillion-dollar AI juggernaut for the limited global supply of those components.
So the global chip fabrication plants are booked solid by Apple and Microsoft, leaving Nintendo fighting for scraps.
Right.
They either halt production of their consoles entirely, or they pay the extortionate premium for the memory parts and pass that hike directly onto you, the consumer. Which circles us all the way back to the Federal Reserve's nightmare. The tech sector's obsession with artificial intelligence is directly making basic consumer entertainment more expensive, feeding the very cost of living crisis the Fed is agonizing over.
Yeah, it's a closed-loop system of inflation. The success of the tech giants is directly extracting capital from the everyday consumer, and not just through software subscriptions, but through the physical scarcity of hardware.
Which naturally brings us to the most heated debate in the market right now. When you have a single company like Micron shooting up 38% in a week and AMD jumping over 18% in an afternoon, the tone of the conversation inevitably shifts.
It has to, yeah.
We move from celebrating the incredible gains to questioning the structural integrity of the entire market. Is this growth actually sustainable, or are we staring down the barrel of a historic bubble?
Well, the briefing indicates that Wall Street analysts are aggressively split on this today, because market gravity always applies eventually, even to tech darlings.
Let's run down the most active stocks of the day moving the volume: Intel, Apple, and Microsoft. Our top gainers are Rocket Lab, up an incredible 34%, sitting right alongside Micron and AMD. But the most revealing data point today is on the loser board.
Yeah, this is key.
Alongside Toyota, NVIDIA actually fell today.
Right.
And the briefing attributes that drop strictly to valuation concerns. NVIDIA dropping is incredibly significant because they have been the undisputed engine of this entire AI rally. Analysts in one camp are sounding the alarm about valuation multiples, while others maintain NVIDIA is a solid long-term buy. So let's make sure that concept is crystal clear for you listening. When we talk about a valuation multiple getting dangerously high for a company, what is the actual math happening behind the scenes that makes investors so skittish?
Sure, let's use a local coffee shop as an analogy. Think of a valuation multiple, like the price-to-earnings ratio, as the price of admission to a company's profits. If a neighborhood coffee shop generates $100,000 a year in pure profit, and the owner offers to sell the business to you for $1 million, you are paying a multiple of 10. You are paying $10 up front for every $1 of current earnings.
Got it.
In a standard, healthy stock market, a growing company typically trades at maybe a 15 or 20 multiple. Investors are willing to pay that slight premium because they expect the profits to grow steadily over time.
But the multiples for these AI tech giants have completely detached from those historical norms. I mean, we are seeing investors willingly pay 50, 80, sometimes well over 100 times the current earnings.
Right, because investors are pricing in absolute perfection for the next decade. They're assuming artificial intelligence will fundamentally rewrite the global economy and generate infinite cash flow without any regulatory hurdles or supply chain failures.
That's a huge assumption.
It is. And here's why that creates a fragile bubble. When the price of admission is 100 times earnings, there is zero margin for error. If an AI company misses a quarterly revenue target by even a fraction of a percent, or if a new microchip is delayed by 3 weeks, the illusion of perfection shatters.
Wow.
The market violently course corrects, that massive premium evaporates overnight, and the stock price collapses back to reality. That's what we saw a glimpse of today with NVIDIA. Large institutional investors looked at the price tag, looked at the actual underlying revenue, and decided the math was simply too risky.
So what does this all mean for you? If the major indices are at record highs, but it's being propped up by heavily valued tech stocks that might be in a bubble, is the average investor dangerously concentrated without realizing it? Like, if you have your retirement tied up in a standard S&P 500 index fund, you might assume you are perfectly shielded from a potential tech bubble because your money is spread evenly across 500 different American companies.
Yeah, that's what most people think, but the reality of how these index funds are built tells a much scarier story.
Oh, really?
Yeah. Most major index funds are weighted by market capitalization. That means the larger a company's total stock market value, the larger the percentage it makes up within the index fund. You aren't putting an equal $2 into all 500 companies.
Oh, I see.
Because tech giants like Microsoft, Apple, and Nvidia have swelled to multi-trillion-dollar valuations, they heavily dominate the math of the index. A massive disproportionate chunk of your safe, diversified retirement fund is heavily concentrated in just 5 or 6 AI-driven tech stocks.
So if the valuation bubble pops, if the broader market decides that paying 100 times earnings for a chip maker is insanity, those tech stocks plummet, and because of that market cap weighting, they drag the entire S&P 500 down with them.
Exactly.
The bottom 400 companies in the index won't be able to buffer the fall. The pain will not be isolated to Silicon Valley. It will hit every single passive investor who thought they were diversified. It is an incredibly precarious balancing act.
It fundamentally redefines risk. You are exposed to the semiconductor supply chain whether you actively chose to invest in it or not.
Now, let's quickly recap the stark contrast we've explored today. The market is operating in two completely contradictory realities. On one side, you have AI chip makers flying into the stratosphere, driving the major indices to absolute record highs as they hoard the world's supply of memory chips.
Yep.
And on the exact opposite side, you have traditional stalwarts like Toyota bleeding out from geopolitical tensions, massive spikes in global shipping costs, and tariff threats. Meanwhile, the Federal Reserve is wrestling with a stubbornly high cost of living that is keeping interest rates locked in place, unable to rescue the everyday consumer.
Yeah, the ultimate question moving forward is how violently these two realities are going to collide. I mean, we are already seeing the AI infrastructure build-out force Nintendo to hike the price of a standard video game console. Think about the sheer volume of semiconductors and memory chips required to keep this AI momentum going over the next 5 years. How long until that artificial scarcity trickles down into the manufacturing cost of literally every consumer gadget you buy?
Like your smartphone, your smart refrigerator.
The diagnostic equipment at your local hospital? I mean, the great irony of this tech rally is that the AI boom, which is single-handedly holding the stock market at record highs, might ultimately become the primary driver of the inflation that worsens the Federal Reserve's cost of living crisis.
A terrifying and very real possibility to monitor as these tech valuations are tested in the coming weeks. That's all for today's deep dive on tech money madness. Don't forget to like, subscribe, and we'll see you tomorrow for more market coverage.